Welcome to the video on spousal RSPs presented by PAIP Canada. So in this particular video, we're going to specifically discuss spousal RSP plans. If you're looking for more general information about RSP plans as a whole, we do have a video that covers that topic, but in today's video, we'll focus on spousal plans. Now, it used to be that the benefit provided by spousal plans was substantial because I think it was a decade ago the government made some changes where they allowed the income coming out of, let's say, a RIF, pension income, to be split between both spouses. It used to be you couldn't do that. And so spousal RSPs used to be extremely popular, especially if we go back a generation or two generations ago, when most often it was the husband who was working outside the home, earning an income that was enjoyed by the entire family. And in a lot of situations, the spouse, his wife, she was working inside the home or engaged inside the home, oftentimes with children or other responsibilities. Over time, we've come to a point where both spouses are working. It used to be, it was typically the husband who was the higher income earner. And so in many cases, and in the example we're going to go through today, it'll be the husband, him, who's working outside the home, who's the high income earner. And we're just doing this to make it more clear. Of course, if your situation is different, you can reverse the order of him and her. Now, because pension income can be split 50-50 between spouses today, a lot of people fail to take advantage of spousal RSPs, but there is still a clear benefit. That benefit is, imagine in retirement or throughout your working career, one spouse is in a high income bracket, high income earner throughout their careers. They're going to have higher CPP, probably more pension income, whereas the other spouse isn't going to have those monies coming in. So why would you want to split something 50-50 between yourself as a high income earner and your spouse as a low income earner if you could give 100% of it to your spouse in a lower tax bracket? And for that reason, we have spousal RSPs. So what happens, a lot of people, they have questions about it. They're not quite wanting to do that right away because they think, well, whose RSP room is it that gets used up? Who gets the tax deduction? So there are two people, a husband and a wife. You have to be married to employ this strategy. You can't go do it with your best friend if you trust each other and all that. You really have to be married. It's for married couples, okay? So you have him and you have her, and in this example, he earns a salary of $100,000 and she earned a salary or did not earn a salary at all. She's at zero. And so if you go back to the RSP video that we did, we understand that if he has earned income of $100,000, his RSP contribution room is going to be $18,000 for that particular year, because it's 18% of earned income minus any pension adjustments plus last year's unused room. Well, we're just going to focus on this year because the point we're trying to make is about spousal RSPs, not about calculating the RSP contribution room. And of course, her RSP contribution room is 18% of zero, which is zero. So, if the two of them as married couples, or as a married couple, excuse me, have an RSP plan at a financial institution, well, you can have an RSP or a spousal RSP. So they have a spousal RSP. So she is the account owner. It is her plan. She gets to make the investment decision inside the plan. Where should the money be invested? When the money is contributed into a plan, he receives the tax slip, which is the deduction. So out of the $18,000 of unused RSP room that he has for the year, 18% of $100,000, he can put up to $18,000 into RSPs. May it be his personal RSP, may it be a spousal RSP owned by his spouse, because he has $18,000 of unused room. he will receive the tax slip, and of course, his contribution room is going to go down. And the whole point of this is saying he's able to save, he's able to get the tax benefit, he's the higher income earner. And rather than having to split the income down the road in retirement 50-50, she, who is the owner of the account, the owner of the plan, eventually they'll turn 71, they'll have to transfer the RSP into a RIF, and then they'll have to start taking payments the year after. Well, she will report 100% of the income in her name. Now, if he has other savings or he has a higher CPP or maybe even a pension plan, he's going to get that. He can share that 50-50, but she doesn't have the CPP that he has. She doesn't work. She didn't earn an income. So she'll be able to report 100% of this, and hopefully she's in a lower tax bracket than he is. That's the purpose of the entire strategy. Now, a lot of people look at this and they think to themselves, okay, perfect. So if I'm working and my spouse isn't working, what I can do is I can just put so much money into a spousal RSP, and a few days go by, and then I can ask my spouse to withdraw it. Well, unfortunately, that's not the case, because there's such a thing called attribution rules. So if you make a contribution in 2022, you cannot, if you're the husband and you're the high income earner, if a contribution is made in 2022 and a withdrawal happens in 2022 at any point during that year, or in the 2 years after that, so 2023, 2024, then there's something called attribution. It will count as earned income for the year in the hands of the contributor, which is him, in our example, the higher income spouse. After that, if the withdrawal is made, even if they're 40, 41, 42, 43 years old, if the withdrawal is made after that, then there's no attribution. It will be taxed in her hands. The rule is the current year plus 2 more years. Of course, then you get people who really think, let's see if we can play a game and figure out how to do this. What if we put in $10,000 every single year for, let's say, 5 years, and then we start taking out $10,000? It's the old money, right? Unfortunately not. When it comes to the attribution in spousal RSP plans, the term we use is LIFO, which is the last money that went in is the first money that came out. And the whole point that the government does this is to say, we don't want you trying to figure out how to income share while you're working. It's only later on when you're retired and the money comes out when you're the age of retirement that you get to do this. So if, let's say, as a strategy, you put in $10,000 a year every year, and then after 5 years you say, okay, let's take it in a month later, or you put it in a month later, you say, let's take it out. Well, the last money that went into the plan a month ago is the first money that's coming out. And so the attribution will apply. It's very important to understand that. In situations where you're, let's say, about to retire, age 65, you're still working, you put money in, you retire. The next year, you're within that 3-year time frame, or current year plus 2 years. What ends up happening is that you have to take a minimum payment from your RIF. Well, the minimum payment is going to be excluded from the attribution rules. However, if you take out more than the minimum payment, the attribution rules may in fact still apply. They are supposed to, but oftentimes what happens is that financial institutions have a more difficult time accounting for which money came in when, and it's often up to the taxpayer to report and to declare that properly to the government. Unfortunately, sometimes this is something that falls between the cracks. Of course, most taxpayers aren't too worried about that. It's preferential for them. They save money on taxes, and that's just the way it is. So I'm looking at our checklist very quickly. I believe that we've covered everything. If you're interested in learning more about strategies to help your retirement to benefit yourself financially over the long term, we do have a link to our website where we provide the first 2 chapters for free of a book that I wrote called Elmer's Nine and Dine. It's Elmer's Retirement Plan, available for sale on Amazon. As always, thank you for listening, and we'll speak to you again soon.